So next I'd like to introduce one of our moderators here today, Bob Johnson. Bob Johnson was a professor here at Creighton and started the first annual Portfolio Practicum class, and he also received his MBA here at Creighton as well. So thank you, Bob.
Thank you, I appreciate it. It's my distinct honor to be here. I love coming back to Creighton. Being a professor at the Creighton, or at the Heider College of Business at Creighton was the best job I ever had. So I have a fond place in my heart for this. I'm going to introduce the panelists very briefly. You all got a brochure as you came in with their bios, so we're not going to take up a lot of time with that. But I do want to say something about this gentleman to my left, John McGinn. I may have started the Portfolio Practicum in 1992, but it would not have happened without John McGinn. I had the idea, and you can have wonderful ideas, but you got to have the muscle to get it through. And I met some resistance in the administration, and John managed to finesse that resistance, and within a couple weeks we had $100,000 for students to manage, so I want to thank John. The other thing that it doesn't say in his bio is you see all these books up here that people wrote, and we've got authors on the panel, Larry, Vitaly, myself. John doesn't have his book up there, but his book is the most influential book in finance, I believe, of quite a while. John wrote Managing Investment Portfolios, and it served as the level 3 CFA curriculum in portfolio management. So you see all these CFAs up here, they all studied what John wrote. So we owe a debt of gratitude to John. Let's give John a round of applause. Our panelists, to John's left is Doug Jackman. He's the Executive Vice President focused on European and emerging market equities at Thomas White International. He's based in Chicago. To Doug's left is Tom Dignan. He's the head of U.S. Equity Intrinsic Value Equity Team at UBS Asset Management, also in Chicago. Next to Tom is Susan Schmidt. She's a Senior Portfolio Manager and Research Analyst at Westwood Holdings in Dallas. To Susan's left is Vitaly Katzenelson. Vitaly is Chief Executive Officer at Investment Management Associates, a value-based firm that's located in Denver. And finally is Larry Cunningham. He's a professor of business law. He's a consultant. He's the author of several Buffett and Berkshire books. He's based in Washington, D.C. and also in New York. So without further ado, John, will you ask the first question?
I will. Thank you for all those kind comments too, Bob. Our role as Bob and I as moderators is to ask questions that the students have prepared for the panelists. And they put a lot of thought and a lot of effort into this, so we're privileged to be the ones that ask the questions. And Doug, we'll start with you. First question is, how has your investing process changed over the years, especially in view of the market conditions of the past few years?
That's a fantastic question. When I started in Morgan Stanley in 1989. I was actually a programmer on the equity and then later foreign exchange trading systems. I think about 3 weeks after I started, you had an earthquake in San Francisco, which threw out systems, which was quite fascinating to see that. And then you had kind of the mini crash in '89. And we were at the heart of what was going on in New York. So that was pretty fascinating. But you fast forward, the world has really changed, particularly in the international and emerging markets. And particularly the last 10 years, and you know, it's really important today because as the Fed begins unwinding and the ECB, we've seen it have a real impact on how our investment approach worked. A lot of our methodologies kind of stopped working when you had a flood of cash and basically free money, if you will, negative interest rates in Europe, and it was a real challenge. And really trying to understand how the world is evolving is key. I think the other thing that's going on that's having a massive impact today is the concept of active versus passive. Today there's, you know, if you think about the Wilshire 5000, you say there's 5,000 stocks in the index. There aren't 5,000 stocks that trade on the New York Stock Exchange or in the U.S. anymore. So the shrinking of the capital markets in the U.S. is going to have a real impact on multiples and what have you. And I think how we deal with that is going to be a challenge going forward.
Anybody want to add anything? Second question. Oh, go ahead.
I
Yeah.
don't know which mic to use. The thing I'd add is, as much as the dynamic has changed, and I agree with everything Doug has said in that respect, the core way you value a business has not changed at all. And the value of any security is the present value, the future cash flows. The interest rate environment might be different, so you might have different discount rate. But no matter when you come out of college, no matter when you start in this business, there's going to be some new thing. And there, sometimes the new thing is something that gets incorporated in your valuation model, and you have to work with it, whether it's big data or now there's big on ESG investing, which I think is here to stay. But the underlying way to value a business has not changed at all since we got, well, forever.
Thank you. Susan, what are some things that you do within your investment process that others do not? Or what do you have that's unique, you believe, to your investment process?
So everybody has to play to their strengths. And I think some people are really great at numbers and data crunching. And I think one of the things, just commenting on the question previously, it is a tougher and tougher market because the information is readily available. So when you think about all the technology has changed, one of the other things that has changed and just it's picked up the pace of information flow and knowledge about the market. So your opportunity for investing, you're doing the same fundamental work as we're fundamental value investors. This is what the CFA is training you for. But a lot of people are able to get the same information and do that work. And so it's, I think, a much faster paced environment than it was 20 years ago. And the opportunities are there for sometimes more limited periods of time. You don't see a company go undervalued for years at a time. It might be months, it might be a quarter, it might be just, we're in earnings season right now, it might just be a week or two after one bad earnings report until people start to figure out what's really going on with that business model. So play to your strengths. What are the differences there? As information is flowing so quickly, what are the differences there where you can actually make a difference? For myself, I really value understanding management's, the strategy that they have and how they look at their businesses and how they're positioning them long term. So I'm here today. Tuesday, I was in the middle of Michigan, traveling through many small towns. And yesterday, I was in Kentucky, traveling through more small towns, meeting with small bank presidents, because I wanted to understand what they're doing with their business. I'm big on that sector right now. I think small and regional banks is an incredibly interesting place to invest because they have so many tailwinds in their industry at the moment. And so for me, my differentiating factor is I'm good at boots on the ground, getting out there, and really getting into their heads. Where are they going to drive this? Do I understand where they're taking it? And do I understand the vision they have for their bank or their business going forward? Can I relate to it? And how does that relate to the rest of the industry? If I think it's a winner, I'll invest in them.
Vitaly, for you? What was your worst investment decision that was unrelated to external factors? Unrelated to external factors. When did you realize that your thesis was wrong, and what did you learn from it?
I'm going to make two comments before I answer this question. Number one, so when I was studying for CFA, I read the blue book that you wrote. Thank you very much. Second, just before this panel, John came up to me and said, so Vitaly, you wrote this, in your newsletter, and you called Omaha Cowtown in the middle of nowhere. I said, I don't think I agree with you on this. And I said, okay, I think I gotta find somebody, but I think this is why I get this question because
Exactly right.
as a punishment.
Oh, you're exactly right.
You still
have to answer the question.
Thank you. Yeah. So the question is, what's my worst investment, and what did I learn from this? So I think if you want to learn investing, your worst investments are probably what they teach you the most, because what they do, they cause you pain, and pain, like when you work out, and you tear muscles, and then when you tear muscles, that basically what causes you to grow. Your worst investments basically are the ones that cause, that basically teach you the most. So I'm going to answer the question though. So I think one of the worst investments, which for a while was one of the best investments, was Nokia. And Nokia, the Finnish phone company, cell phone company. And the first time we invested in Nokia, we made a lot of money because Motorola came out with a clamshell phone and they had a bar phone, and Motorola stole a lot of market share from them. And then Nokia made clamshell phone and they took the market share back. So we made a lot of money. So that investment taught me when you have a competitive product, Nokia can innovate, great, buy Nokia in this situation. Then there was a little company, Apple, came out with iPhone. And I'm like, well, when this happens, you buy Nokia, right? So obviously you know what happened then, right? But we got a very nice loss. I don't know, 50-60%. It was a nice loss. But what it also taught me, there was a lot of lessons that came out of this. And one of the lessons was that when and I can apply this is when you are an incumbent. It's very easy to assume that when you're going to have a new threat, the incumbent is going to be able to react. But what happened in the case of Nokia, you basically had a company that made dumb phones and had a little bit of software. That basically it was a hardware company with a little bit of software. Where Apple was a software company and a hardware company, okay? So the response that Nokia had, they basically took a dumb phone operating system, Symbian, and tried to make it smart. So, which did not work. And so what I found, it's extremely difficult for the incumbents to react to threats where the threats are asymmetric, but also where you basically have to reap everything out of the company and start fresh, right? So what Nokia should have done, they should have started a completely new division, hired brand new people that did not have all the baggage that came, and then they would have. There was absolutely no reason why Nokia could not have been a very successful company, but anyway, so I answer your question. Here's my answer to your painful question. So.
Thank you. We won't make anybody suffer through reciting their worst investment, but Larry, what are some reasons that companies become attractively priced, and which reasons do you embrace as an investor, and which ones are you more careful about?
Well, that's a great question, and if I can also start with a comment. First of all, you are not alone. A lot of people made the mistake of Nokia. So, and also just want to commend the leadership at Creighton that have created this wonderful panel. This is the 10th one, as I understand, and that's a milestone, and the leadership is to be commended. And I want to single out John Wingender, who I think played a role in this. One of their colleagues and a great and revered teacher here. There he is, hey John, and generously contributed to a recent book that we've just put together, reflecting upon the wonders of the Berkshire Hathaway Annual Meeting, and he regales us with the history of this panel, how it was created, and the leadership who have put it together. So thank John and the leadership for that, and it's a delight to be here. I think there are many reasons that stocks may be underpriced, and I would pay attention closely to reasons why there's a departure in price from value, and to the extent it presents an opportunity, there's an investment that you understand, that you have a high degree of confidence that its value is a significant premium over its price. It doesn't really matter whether it's fear or panic or ignorance or other reasons why it might be an opportunity. But I think this relates in a way to the first point about how someone's investment philosophy or technique might change over time. I agree with Doug and Susan that the opportunity set may differ. There may be more competition. There may be fewer opportunities. But I also agree with Tom that the core methodology remains the same. The basic valuation equation remains the same. The basic insight or technique of value investing, of comparing price to value, remains the same in any environment. It reminds me of a great quotation you probably all know it from one of Warren Buffett's letters when he was talking about how the economic environment changes so much and uncertainty is often present, and fear very often infects markets and leads people to do irrational things, including irrational things that lead to price depression and opportunities. And his famous quote is that fear is the foe of the fattest and the friend of the fundamentalist. And so a lot of alliteration there is a powerful thing to remember. And he made that alliterative quote in the context of saying that Ben Graham laid down some very basic, universal, and timeless principles in the 30s and 40s, and nothing about the macroeconomic environment, the geopolitical environment, the psychology of markets has changed those fundamentals. And that's really Tom's point. And I think a honed, relentless focus on that, Bob, that says there is a discrepancy between the price at which I can buy this and the real underlying value there. Maybe due to fear, panic, pessimism, whatever it is. But if you have a high degree of confidence, I mean, that's an opportunity to seize.
Let me,
Good. Okay, next question.
Do you want to
Doug, this goes back
I
to
was gonna add something.
Oh, pardon me.
I was gonna add it. So I think one of the biggest competitive advantages a value investor could have is a long-term time horizon. If you have a long-term time horizon, that you often see opportunities where the Wall Street has a short-term time horizon, and that's how a lot of opportunities are created. So you have a company that is not expected to do anything in the next 6 months or a year, and therefore the stock gets get depressed. And if your time horizon is longer than 6 months or 12 months, which it should be, then that in itself creates an opportunity. So just wanted to add that.
Good point. Next question is for Doug. In your investment research process, how deeply do you look into management's background for potential red flags?
That's a great question. Our firm's process has a little more of a quantitative bent to it. So while management's important, we don't spend a whole lot of time on it. We are at $2 billion. We don't travel the world and kick the tires as some do. But I think you do want to understand, particularly when you get outside the U.S. and emerging markets, understand the relationship of the ownerships to either the large families or the government, because that has a huge impact. But you also want to be careful not to bring politics in too much. To the earlier question, we missed out on a couple of investments in Latin America and Brazil in particular because of all of the attacks, if you will, at senior management at some of these companies, and they were up 500-600%, even though from our research, our valuation research, they were amongst the cheapest stocks in the world. But we were a little fearful because they were attacking the chairman and the president, putting them in jail. So you want to be cognizant of the governance aspect of it. And I think that goes to other investments too. You want to understand management, but I think a classic value style, a lot of times when a stock we find mispriced, some of our best investments, what happens? Oftentimes they replace the management, bring in new management. And the story we like to use is, when the new guy becomes the chairman of Home Depot or GE, bad example today, but when they took over for Jack Welch, there were 3 people who knew that they weren't going to get a job for 10 years, so they all split, went to 3M and elsewhere, and those companies had some of the best managers in the world. So you do get to take advantage of that, so it does matter.
I would add that I think the proxy is one of the most valuable pieces of information that publicly traded companies give you, and it is underread. So I think it's incredibly important to take a look at how management is compensated and understand what their drivers are, and make sure that that is driving the company in the right direction. And I also think it's incredibly interesting to see who's on the board and what the connections are between the people on the board, because that can, I find, give you clues to the strategic direction of the company, to the strength of the board versus the CEO, and how much drive there is in that management team and the board to keep the company, pushing forward.
Susan, can you pull that mic up a little closer to you, and maybe all of you. They're having a little trouble hearing in the back.
Uh-oh.
We can hear fine.
No one ever says that about me normally, by the way. Everyone can always hear me.
Thank you, sorry.
Susan, what is one big red flag in a proxy statement that you would say, okay?
This is I'll tell you one of my favorite stories. And it's not a proxy, but it's natural. I had a breakfast with a CEO who shall remain nameless. However, if he were in the room, he would know who he was. So I had a breakfast with a CEO, new CEO. He'd come from a very big company and had taken over, a great operator, and had taken over this smaller industrial company. And he and I were having breakfast with others, and he was talking about his business. And I owned the shares at this point. And I was very excited because we'd seen operational improvement, margins were expanding. And during the course of the breakfast, he told me how they had an outside consulting firm come in. They'd redone comp and how compensation was going to be awarded. And they had an outside company, consulting firm, come in and do the new structure. And in the new structure, they were compensated strictly on the growth of earnings per share. So I questioned him on that and said, well, you know, he waved, now this is a very smart man, and he waved it off and said, oh, you know, well, we just got an expert to do that. I don't know anything about that. No one takes the job as a CEO and hasn't looked at comp and how this works. So that made me nervous right away. And then I questioned him on what else besides growth of earnings per share? And remember, I already own these shares. Well, we just need to have growth of the business. As it turns out, it's growth of market cap and earnings per share. So now I'm thinking, all right, how does this work exactly? I left the breakfast and I was very uncomfortable. I was very uncomfortable because he didn't talk about return on invested capital. None of these metrics were tied to operating margins. None of them were tied to leverage. So all areas of risk, right, that can change my investment profile on this business. 2 weeks later, he issues equity, massive dilution to all the existing shareholders. I'm happy to say I was so upset after this breakfast, I started selling my shares. So he diluted everybody. He went and he bought another company. And fast forward a year, with funky accounting, you had a worse performing company that was doing not well, but the earnings per share was higher. And so he was going to get paid more. So that's where I said, pay attention. They tell you every day exactly what they're going to do. Read between the lines and connect the dots, because it's there. And a lot of it's there in the proxy. So things like that. How was he paid? Very important.
Thank you.
Could I add to this? And
Absolutely.
I'm going to add to, it actually combines a couple of questions at once. So one of the things we changed in our firm over the last couple of years, closer? Okay. We basically, when we look at companies, we look for three things, and this is broad, three topics: quality, valuation, and growth. Okay. And in the past, I would basically say, well, this company is so cheap that, yeah, the quality is kind of, it's not as high quality business, but it's so cheap that I'll buy it. So for the last couple of years, we made quality absolute. So in other words, when we analyze a company and we find that it has too much debt, and to your point, it's gonna have dishonest management, or there's something we don't like about management, we stop. It doesn't matter what the valuation is at this point. We stop and we move on. And one thing I appreciate now as I get older and I do this longer, people, is that, which is something, try to put that into modern portfolio theory, right? Try to put, but when we analyze companies, we look at people a lot more now. And I basically will never, ever, ever invest in a company where I don't respect management. And so that's my answer.
Thank you. Tom, how do you maintain a value focus when you're evaluating new technologies and companies in high growth industries?
I guess I'll go with this mic. Hopefully you guys can hear me. I think for an intrinsic value investor, technology might be one of the most challenging industries. And the key in valuing those types of companies is understanding who can actually develop a moat, and you have to have a vision. And I'm not sure, my technology analyst, Mike Nell, might be here in the room. But I'll tell you, he's someone who was able to embrace an intrinsic value philosophy. Like I've got to model out cash flows, and where you have a lot of companies entering the industry that don't generate cash flows initially. So, they say to be a value investor, you have to have, a creativity plus a calculator, and that really is required. So you need somebody that really understands the underlying technology and understands the industry. And you have to see, can an Amazon create a moat, right? Which they've been able to do. So I think a value investor can have technology opportunities, but you really do have to have a vision. You have to be willing to look pretty far out.
I would add to this. I think one of the things that we saw, going back to the earlier question of the worst investment, part of that is learning from your mistakes, learning from your losses. As an athlete, I think is probably more important and more valuable than your winners. And if you go back to the tech bubble in the late 90s, there was a real challenge. And if you stuck to your guns, value came through. Fast forward, the technology is very different with the internet, the Amazons of the world, the Alibabas in China. And how do you take advantage of understanding that disruption that causes? Because this disruption that's going on is really kind of once in a lifetime. Now, there'll probably be another disruption in 10 years that we can't see now. But trying to learn from those mistakes of what did I miss, why did I miss it, and then looking at the valuation and the earnings and saying, how does this come into play? Because they're not, 7, 8, 10 multiple stocks. But understanding that growth is real and the disruption is quite real as well.
Could I add one thing on the other side of it? Oh. Yeah, the other side of it, what Doug said about disruption, what that does is it creates historically what looked like real value plays, where you look for some kind of mean reversion and think, well, this company's beat down, but it'll come back. Well, with the disruption that we've seen with technology, you have a lot of these, traditional value plays that are really value traps, right? It is the melting ice cube, and we're in, I think Seth Klarman had a good phrase, and it's global financial warming. The ice cubes are melting much faster than they historically have, and think U.S. retailers. If you don't understand technology and what's happening there, you're more likely to get hit by a really big blind spot on the value side of things.
The next question is from, as we said, all of these questions are for the practicum students. In the practicum class, we rely heavily on both qualitative and quantitative analysis. How important are each of these in your analysis process? Tom?
Oh, yeah, so ours, qualitative and quantitative, when I say we're trying to figure out what the value of a company is, so we're putting out those estimates of future cash flows, which is a number, but it's very qualitative, and it's based on just bottom-up research. So I'd say we're probably heavily weighted towards the qualitative side of things. And I think on the quantitative, a lot of it is just an awareness. If you're a fundamental investment manager, you want to know where the risks in your portfolio are coming from. You want to know kind of the metrics of your portfolio, but you don't want to get away from the core of what you do, which is, valuing companies. And to the extent that's what it is valuing management, valuing the industry, the structure. If a stock looks cheap, you better know why, right? Is this a mean reversion story? Is it a structural winner? Is it maybe strategic value? Somebody else wants to own it. And at the core of what we do, it's really driven around that, which I think is more qualitative than quantitative.
And I'll chime in on that. So again, with this, how the world has changed in the last 20 years. And I tell the summer interns and the young analysts that come in and are working with me, you've got to go beyond the numbers. Quantitative is where we start. The way we value things hasn't changed. We still care about cash flow yield. We care about the interest rate environment that we're operating in because it impacts how much we expect for the risk we're taking on investing in this publicly traded company. All those things are very technical, and those are the quantitative parts of it. But as I tell all my younger associates now, technology has spread so much, everybody's got the numbers. I can be living in a hut in Tahiti. I can get the same financial statements that everybody else has, and I can take those numbers and I can churn them through some sort of model, and I can get a valuation. The numbers alone won't do it. There's the qualitative overlay, understanding the strategy, the management, what the business is doing, the industry the business operates in. All of that becomes incredibly important in, again, now it's an art and a science, combining the two, bringing that something extra so that, you can come to a conclusion where you may be in agreement with where the stock price is trading. You may be in a very different position and have a very different value for it. But if you don't marry the two, I think you're really missing out.
Could I? Susan said two words, arts and science, and it really triggered this. So I feel like value investing is usually misunderstood in general because people read The Intelligent Investor and they basically get a recipe out of this. Okay, they're saying buy cheap stocks. In fact, you ask most people what value investing is, and say cheap stocks. In my mind, it's so misunderstood because if you read that and you get the recipe, buy stocks at 8 times earnings, that is that was part of the message. I don't know, but there is a philosophy that is embedded in the Intelligent Investor, and the philosophy basically I call it the 6 commandments. The commandment number 1 is basically you look at stocks. You look not as businesses, not as a piece of paper. You look for margin of safety. You need to have a long-term time horizon. Risk is not volatility, but permanent loss of capital. In the long run, stocks revert to fair value, and Mr. Market is there to serve you, not the other way around. Those things, that's a philosophy, okay? And that's where really, when you read Ben Graham's book, that's what you should get out of it. If you get the recipe out of this, then as Susan said, you basically will be competing with computers out there who can count to 10 and say less than 10 times earnings is good, okay, or price to book less than 1 is good, okay? So it's really, and if Buffett, and Buffett would tell you the same thing, when he started investing, he was basically kind of a Ben Graham recipe investor. And Charlie Munger transformed them into what, to where Warren Buffett is today. So I would argue that Ben Graham would never buy Coke when Buffett did. But Buffett saw that Coke had a huge competitive advantage and had a huge growth runway. That's something that the computer would not catch, 10 times earnings would not catch. And I think that's what made Buffett so successful, is able to see beyond the numbers and embracing this philosophy and being and approaching investing as art and science and being creative. So
I think that's profoundly right. And I think this question about what's the relative importance of quantitative versus qualitative analysis dovetails a bit with the prior question about the role of management in an analysis. And you could have a wonderful corporation that has a very high intrinsic value, but if you have managers who lack a shareholder orientation, shareholders may not gain from that business. So I think it's very important to do the quantitative, to do the analysis, to follow those 6 tenets of the Graham Catechism, but then also to investigate managerial quality. And I think Susan's exactly right that you can get terrific clues about whether managers are faithful stewards of shareholder capital by looking at their compensation, especially around stock option accounting, stock option granting in the first place, and then how it's accounted for. And if you do the math on a lot of stock option accounting in America, even when they're complying with GAAP, a lot of wealth is being transferred to managers that is not accurately accounted for. And so, and some managers are worse around that and others better. And that will speak volumes to the qualitative side, to the appeal of a business. And on one extreme side, you'll have a company like Berkshire Hathaway that has never paid managers in stock or stock options, with one exception when they acquired BNSF to honor existing stock option arrangements, because Warren believes that that's a transfer of wealth from the shareholders to those managers. And while someone who exercises the option and becomes a shareholder does indeed walk in the shoes of owners, how people acquired their stock really does matter. It's a qualitative point, but it affects the culture. It reflects on how management think of their role. And again, the special thing about Berkshire Hathaway is that it's a company that was created by an investor and it's run for an investor. And it's very rare. Most companies are built by managers, built by entrepreneurs, and have a managerialist orientation. But there's a range, and I think you will do better by trying to probe which managers tend to have that own orientation, tend to elevate the interests of stockholders above the interests of managers. And you can certainly get at that by probing the proxy statement, how managers are compensated, who is on the board of directors, how they think about investor stewardship, whether they focus on return on invested capital or earnings per share.
In the early days of the class, Mr. Buffett actually came in and talked to the Portfolio Practicum class. And one of the students asked him, "What investors do you admire?" And he immediately said, "Seth Klarman." So I went out and I had the students all buy Seth Klarman's book, Margin of Safety.
It's an expensive book.
That's the story I wanted to bring up, was the fact that the book ended up being a short print book. It became a cult favorite, and it was selling for over $1,200 on eBay. And some of the students actually contacted me and said that that was the best investment they had ever made, was the $18 that the book was. And I wondered if they ever read it. But Doug, I wanted to ask you about margin of safety, because Vitaly brought margin of safety up. How do you incorporate margin of safety in your investment process?
Yeah, through our approach, we're really looking at the valuations compared to other companies within their sectors, and we start with a long historical analysis. So that's really the beginning point of understanding, how a company's been priced relative to its past. And I think that's been it worked quite well. It's kind of a classic value approach. But I think what we see in today, particularly with some of these disruptions in technology and what have you, we're looking more on quality and consistency of earnings. That's really been a key driver. But one thing I would just build on your statement more than a question is who do you admire as investors? And I think this is particularly for the younger people, I think very important. We were fortunate to have run money for John Templeton when I joined the firm in '95, and there was a 30-year relationship there. And he obviously was a fantastic investor. And he had a time horizon that wasn't 6 months or 12 months, but 10 years, 20 years, and his foundation will long succeed him. And I think understanding what he was looking at, his concept of point of maximum pessimism, there's a lot of truisms there, but it's really hard to be fully invested in the equity markets when they're down 40, 50%. And his comment would be, well, I was a year early or 2 years early. And those markets have indeed roared back. And so I think trying to find 1, 2, or 3 people that have had a long-term and really survived the time, like a Templeton, a William Gray, who's actually a South African, worked for Peter Lynch, who's based in he's based in Bermuda. Peter Lynch is obviously another great investor, but trying to understand their approach long-term that really was a time-tested, I think, is key.
Can I add, because I like that question. The person I probably admire most in the investment business is a guy, Gary Brinson. That's who I began working with at Brinson Partners. And I bring up Gary partly as a great investor, very long-term focus, and the fear and greed that embeds the market, Gary just never really related to. And to him, this is what a security is worth. I know the fear and greed is going to rocket all over the place. We have our true north, that intrinsic value. And he worked with a guy, Jeff Diermeyer, who really instilled the highest level of ethics within the organization. And the reason I want to bring them up is I feel like I was fortunate. I had 2 mentors. So when you go out, especially the Creighton crew here, looks like these are all the people coming out into the workforce pretty soon, you may or may not work with people you really admire. And if you don't, you need to go find another place to work. It is so important that you have people that will invest in you and that you believe in and that do things the right way. And, that's a key part of your success. If you do that, you guys the foundation has been set. You guys are pretty fortunate to become from the school. And, but just make sure that you have somebody that you can follow and someone that'll lead you and help you learn and actually empower you. And, so good luck.
Well, I'd just make sure we add to the list of great investors the person who's probably done more for more investors than anybody else, and that's Jack Bogle. who invented the index fund, or at least popularized it, and offers the opportunity for what Warren calls the rocking chair investor, the know-nothing investor, ordinary people who don't have the training that the Creighton team will have, or that this group has, but that nevertheless have capital and have retirement and other personal needs, and aren't interested in picking stocks, but do want a solid return. And so he invented the index fund, and tens of billions, hundreds of billions of dollars of capital are now allocated based on just a slice of the market at a very, you get the market return at an extremely low cost. And I don't know how many of you were here at the annual meeting last year, but it was Jack's 89th birthday, and he and his friends and conspired with Warren to fly him out. It's the first time he's ever been to a Berkshire Hathaway meeting. And they singled him out, and Warren had him stand up and said, if a statue is ever erected for an investor who's done more for investors than anybody else, the statue ought to be for Jack Bogle. And so when we're listing the pantheon of Seth or Warren or anybody else, we should always remember Jack.
Very good. I think we want to provide an opportunity for questions from the audience, and we really appreciate you all being here. We know you've got some very good questions. The students will be here with microphones, wherever the students are.
Microphone's right here.
Pardon me, right here in front. I see this. Okay.
Who's got a question? Who wants to lead? Because I can throw another one out, but who's got a question? Up here.
Come down
Right
and
here in
just
the middle.
use the mic here. Can you see it at the foot of the stairs?
Take the mic up. Yeah.
No, you don't have to share. You're a good share.
Nope, we'll take the mic up.
Hi, at what valuation do you think GE becomes a value play, something that you guys would look at?
When does GE become a value play?
I have a non-answer to this question. So I think it's an invaluable company in the sense that you can't really value it. So the problem with GE is that the Jack Welch has been put into the history as the best CEO ever walked this earth. And I would argue he probably one of the worst CEOs that ever walked this earth, because what he did, he made the culture of GE very toxic and very short-term oriented and focused on beating the earnings. In his book, in early 2000, he wrote this book, Straight from the Gut. In that book, he talked about how he was so proud of his managers because they could always beat the earnings. This is not me saying it, this is him saying it. And so what basically happened, you had a GE turned into this incredible company into a company that is very short-term oriented, that's focused on earnings. And they made through the last 20 years, they made a lot of horrible acquisitions. So one thing about, as Thomas mentioned, the value of any asset is a present value of its future cash flows. But there is an assumption that this cash flow is not burned and not just doesn't just go in a garbage can. So with GE, they destroyed hundreds of billions of dollars of capital through these horrible acquisitions. And also in the meantime, the corporate culture got destroyed. So when you try to analyze a company today, to me it's unanalyzable. I tried it half a dozen times, and it's just you really have no idea what's in there. And as we just been discovering the last 6 months, it's worse than it looked. So to me, at this point, it's unanalyzable and therefore not viable.
Can I jump in with a quick question, Vitali, to follow up on that? Why do you think Jack Welch was motivated that way? So focused on earnings, focused on short-termism, focused on, every business had to be number 1 or 2 in the market or it would be sold out. What do you think motivated him? I've got a hypothesis, but I wonder what you think.
So I think what happened was Wall Street rewarded companies that can produce earnings, beat the earnings, right? And GE, it gave them competitive advantage for a while because it gave them a higher price to earnings, right? And they used the price to earnings to buy companies with lower price to earnings, and that has created value. The only problem is that is not a sustainable strategy in the long run because you can't control price to earnings. The market does, okay? And so that is a castle that's built on sand in the long run. And I think that's what we see today.
I totally agree with you. And I'm bringing it up because Warren has this wonderful quote that you get the shareholders you deserve. And I think management plays a very big role in the leadership of a company, but I also think the shareholders play a role. And the shareholders of GE during that period, we referred to Wall Street, they wanted that. They loved earnings per share climbing just like that every year for 40 quarters, for a very long time. Jack never missed a quarter. And it wasn't just through internal management, operational massaging. There was some massaging of the accounting too. And I think General Electric shareholders like that. And that's why he became famous as a great CEO. Berkshire is very different, right? This group, very long-term oriented, doesn't want a dividend, is very happy with a lumpy short-term return because they're focused on a very long-term and infinite time frame, basically. And so there is faithful accounting, no interest in divesting non-performing assets. And so I know we departed radically from what's the break point, but I think it's important when you think about a break point question, what is the culture? How would you think about it? And I think they've got a lot of work to do to fix that culture.
So I think the key is that it's a broken culture. And I think that is, so, and one thing, out of my long laundry list of mistakes, like in one of my mistakes I didn't mention was Hewlett Packard, which ended up working out, but it was a lot more painful. One thing I learned from that it was a company that had it wasn't just a turnaround, it was a turnaround with a broken culture. So when you look at GE, you have to have the same mindset that it's not just, the company has a broken culture, and that takes a much longer time to fix. So.
Hi, this is a question for Lawrence. If you were just starting out in investing, either because you have a large amount of capital to invest, let's say for your family, and given the historically high levels the stock market is at right now, I know Warren and Charlie say that not to pay attention to either the macro or other external factors, but how would you take that into consideration, or how do you think Warren would take out into consideration the very high historical level of stock market and the bull run that's been going on if you're just starting out and you have the responsibility to allocate capital for other people?
As Susan said, the opportunity set seems to be smaller, partly because of competitive factors, because of the dissemination of information, technological skills of investment analysts. So it's a very small group of companies who have delivered sustained high returns on invested capital for significant periods of time, at least among large companies. So it's a very difficult exercise. But when I do that kind of work, and I don't necessarily think what I would do if I was just starting out is very different from what I'm doing now. My investment horizon is extremely long term. I'm looking out for my children and their children, and so I'm not sure if the time shift would make very much difference, but I'm scouring the universe for sustained high returns on invested capital at businesses I can understand, run by people who I believe have a shareholder orientation. And when you go through that kind of rigorous analysis, the result is a very small handful of companies. I'm also very interested in tax-efficient companies. I'm not interested in dividends particularly. I prefer the magic of compounding for the company with high-quality management and good opportunities for incremental investment of capital. Do it at the company level rather than give it to me. So when you get through it all, I'm a big fan of Berkshire Hathaway. I think I'll hold it forever. I'm a very big fan of a company whose board I'm on, Constellation Software, which is run by an investor, created by an investor named Mark Leonard, which is a roll-up of vertical market software companies. It's from a standing start 22 years ago, is now a $15 billion company with sustained returns on invested capital over nearly 25%. I mean, it's been doing what Berkshire did in its first 20 years, but there aren't many of these opportunities. But I want to make an observation on your question. When we started the panel, I said that Vitaly would be taking all the hard questions, and I'd be taking the easy ones. Yeah, so I want to make sure he gets a chance to.
Can I jump in?
I have a short answer. Take the hard question.
It was a really good question. If I had to bet, someone will ask it next year, because someone would have asked it most of the years I've been alive. In most of the years I've been alive, the market has hit an all-time high. The market is not a zero-sum game. It goes up over time. If you're a long-term investor, you should be in equities.
That's the question I wanted to follow up with. I want to challenge the premise of this historically high valuation levels? Because when you look at PEs, you have to look at them relative to something. And where interest rates are, which Warren has often said that interest rates act like gravity on stock valuations, do you folks believe that we are at historically high valuation levels? I'd like to know folks' opinions.
I'm going to make this more interesting because I'm going to disagree with Tom. I'm going to shamelessly, and to make things even better, I'm going to shamelessly self-promote 2 books that you have there. When I did research for my first book, Active Value Investing, Making Money in Range-Bound Markets, I have looked at historical markets of the last 100 years. And what you find is that if price to earnings always stayed at 15 times, always at that level, and then basically over the last 100 years, you would make about 5% from earnings growth because earnings are going up, and you make about, 4 or 5% from dividends. So you would make this 9 or 10% a year return forever. Except price to earnings doesn't stay at this level. And this is kind of the thesis of my book, is that price to earnings is like a pendulum. And it goes from one extreme to another. And as that pendulum goes from low to high, that basically supersizes your returns, and you have 82 to 1,000 kind of returns where you made 15, 17% a year. But the problem is, it's one of those pendulums that goes the other way as well. And when you go from high valuation to low, the earnings can grow and dividends can, get deposited in your checking account, in your Schwab account, but as price to earnings declines, it's going to wipe out the benefits of this earnings growth. So to your point, but you're going to say, well, valuation is not high. So that's would be your, and this is where it gets very interesting, because you look at every single measure except price to earnings, and that's probably the one that matters. The stock market valuations are extremely high. I mean, okay, but the problem is, if you look at price to next year's earnings, they don't look expensive. But the key is this: the corporate profit margins today are at the basically almost all-time high. Historically, profit margins have never stayed at these levels without mean reverting. You look historically; they did the same thing as price to earnings. So at some point, as the earnings, the profit margins will decline and valuations will look less attractive. So that's my rebuttal.
So I can be short. Margins have been driven by technology revolution, which I think margins are going to stay where they are. I don't see a big decline in margins. And if you're very wealthy and you're investing, you can get 3% on a 10-year, okay? 10 years from now, you won't still be really wealthy, but that's your return. And that's your alternative.
So
Right.
two things, and So two things. Number one, and all these points are valid. Except, so the problem is you assuming basically that the interest rates will be at this level, and I have no idea where they're going to be. But there is a very good chance they're going to be a lot higher. And if that happens,
So you want bond exposure?
No, I'm
okay.
I'm not saying this, but I'm just saying that stock's not cheap. That's number one. Number two. There is a concept of economics called fallacy of composition. And basically, in fallacy of composition means that if you are in the stadium and you want to see something, and if you get up, you'll be able to see it, but everybody else gets up, you won't be able to see it. So the problem is this: the technology is available to everyone. And therefore, Walmart, 20 years ago, had a competitive advantage because it had the best technology. But now you can write a check to Oracle for $500,000, and you're going to have the same technology as Walmart. My point is, in the long run, the technological advantages get competed away. But anyway,
I'll make 2 comments to be a little bit of a blend of the two. I use a simplistic real life example. In Illinois, they came out with a 529 plan, as they did in many states. My son, who's in this role, he's graduating from college this year. Put in the max, put it in 100% equity, which was, you had about 8 options, and just let it ride, and put in the money every 12 months. And lo and behold, what did we have? We had 98, 99, one of the biggest bull runs in a while. We had the bubble bursting. Then we had 07 and 08. And if you took the 10 options that were blended, you had all these time frame ones. If you looked at the 10 options, what was the best performing selection? It was the one that was 100% equity. There were some 40% down markets. You had a lot of volatility. But I think going to Tom's point, the markets can be perceived to be expensive, but you don't know. It could have a 5 or 6 or 7 year run, and then you're going to give some back. But in the long run, whether you go back 100 years or 20 years or 50 years, equities in general outperform. I find it a little ironic that you don't have a single bond manager here, maybe for a good reason.
I find it refreshing.
But I think if you think about that, I mean, to your point in particular, you have to start with a game plan. You know, the classic, if we want to steal it out of John's book of, you know, return, risk and return, the objectives, and break it down into kind of the 7 different criteria, with taxes being one of them. You got to have a plan, and you got to review the plan. And what I've seen, and I deal with a lot of clients from, you know, endowments to some of the biggest plans, they're all run by humans. Humans run CalPERS. Humans run, you know, the state of Nebraska Investment Committee. Humans have the same biases. They think they're afraid of missing the market, so they might get in too late. But you got to have a plan, and it should start by reviewing that plan on a regular basis. No matter what asset class, we kind of just talked about equities, but if you throw real estate and alternatives, a variety of other things in there. But in general, I like to say, what is private equity? Private equity is investing in companies that don't trade on a daily basis. But if you have a 10-year horizon, you're investing in companies with management. They just don't trade on a real-time basis. In reality, it's the same analysis that's going on. And in my very first point, I said you have a shrinking of the number of stocks. That's an issue, but it's not, because there's a lot of money chasing this. But they still got to make the same bet of what sector, what company is going to do well. And there's a lot of advantages of being private. I mean, the regulation that exists today, while getting a little tempered with the current administration, is pretty significant, and the costs of, you know, public reporting are steep. So go private, because then you reduce all of this requirements, and we're talking millions and millions of dollars of filing these things with the stock exchange and the SEC and what have you. It's a real cost.
Yes, I had a question. So my question related to consumer staple stocks. You, I'm sure, analyze different sectors and have noticed that one perhaps down a bit. Some of the companies I follow down 20, 30, 40% that area. Kraft Heinz, General Mills, those type stocks, recent negative report on Pepsi. If any of those popped up on your radar, any of those you're taking seriously, any of those you'd want us to stay away from?
That's such a loaded question, right? Because some of those are like bellwether names that everybody owns, or you want to have some. And staples have been a place where it's defensive when you're worried about the market or you're worried about what to do. You look to consumer staples because it's that steady, no matter what, you know, people are going to eat. It's 2 to 3. It's going to match GDP. You'll be fine. These companies are very stable. I think right now, for me, I am more skeptical and cautious on consumer staples than I have ever been in my career. And I am skeptical on the consumer sector in general, not just staples, but discretionary too. And this is a great audience to address it in because we have such a range of ages. So I believe that social norms are changing as we move from one generation to the next. And, you know, consumer staples right now, we're all really nervous because if you're in the middle aisles and that's where your product lines up, your sales were probably down in the last quarter. You're not showing growth because people aren't flocking to your product. Everyone is not waking up wanting to have, you know, cereal, or we're not. I don't know what happens in your state, but in Illinois we have a sugar tax, and so those cans of Coke that you used to get are now like super, super small. What happened? Right? Suddenly it's negative. You don't want to be having sugar, which is good because both Coke and Pepsi own water companies. They saw that coming. So it's very interesting to me how we're changing. How many of you actually went, because I have a big number of you, I'm going to ask you to raise your hands. How many of you have been to a mall to shop, so you had to purchase something to shop in the last 30 days? Right. How many of you have bought something online in the last 30 days? There we go.
Oh, wow.
That was great. Okay. So there's my point right there. Our need for bricks and mortar is going down. we're shopping, but we're buying in new ways. I guarantee you, these guys over here are not looking to get their fourth ugly Christmas sweater to win next year's competition. That's not what they're buying. They don't want more stuff. They want experiences. Whereas, my parents wanted stuff. They wanted more things to put in their home. These guys could be living in their parents' basement. Sorry, guys.
No. No.
And they'd be fine with that. And your parents, catch them early. If you're going to do this, do it right when you get back home from school because your parents still want you back. So,
No.
Except for this one. So it's a change. I'm really cautious. I typically in my portfolios have been overweight consumer. I've outperformed because I've had great consumer names. I am underweight consumer for the first time in my career. And I don't have as many names in consumer discretionary or in consumer staples because I think we are at an inflection point in how our society functions and how that impacts consumer stocks. So that's very complicated and it brings you into more sectors, but pay attention. I think it's a tough sector.
Let me add to this. So if you look at the last 5 years, 10 years, this companies, they call Kimberly-Clark, whatever, they were basically owned as bond substitutes, right? Because people basically say 10-year treasury is 2.5%, Kimberly-Clark was 4%, that's better than bonds. And people wear diapers, they get older, whatever, all those different things. And that's why we're going to buy Kimberly-Clark, right? Except, 10-year bond does not have to stay at 2.5%. And so these companies basically traded as basically an inverse of bond, 20, 25 times earnings, and they have very little growth. And to your point, the internet has changed the dynamics in retail. And it changed it in the sense that in the past, their competitive advantage was not just the brand, but also controlling shelf space. And that competitive advantage today is gone, right? And therefore, the dynamics in the market are changing. And therefore, a company, like let me give you one of the best examples. If you look at Gillette, they dominated completely the shaving space, and they raised prices every year to the point where you have to pay $5 or $7 per razor, which is insane. And they thought everybody loves us, we can do this because we are the brand. Well, what actually happened? The reason we were able to do this because they control shelf space, not because they had such a great brand. So internet comes along, and you have a dollar shaving club, and suddenly this company becomes a $1 billion company overnight. Through because actually Gillette created negative brand by raising prices so much for so long.
And technology allows us to do that, right? You got Dollar Shave Club. You can we talk about disruptive technologies, and you think about, we have these hallmark names that come up in conversation every day. You think about Uber, right? Well, that affects our whole auto industry. That's a huge industry for us, right? Then you think about Airbnb. What does that do to hotels? Right? We're getting much better at improving our own return on invested capital. As individuals, we're doing exactly what we as investors want businesses to do, to better utilize their capital base. And so as a society, we are starting to do that. And it's because of technology and how things have changed and how we can pool resources and utilize resources more efficiently that it really is changing a lot of dynamics. And it's a fascinating time to come out into this profession because I do believe we are at an inflection point. And so we're seeing a lot of new avenues and business models open up that were never considered before because they weren't possible, and now they are. And I do think we really are at an inflection point as to the different roads we take and the norms, the new societal norms and patterns that become adopted.
Yeah, I would add on to Susan's comments, and it's not just in the staples like we talked about, but it's finance. It's obviously the Ubers and Lyft. If I took a poll of everyone left of this aisle here, my guess is everyone's got a fair bit of cash in their pocket. And if I poll these 50 people here, I'd bet you none of the students have more than $20. Does any of the students have $20 in their pocket or more?
Do you even have 10?
We got 3. But
he's fine.
But if you think about that, that changes how banks. 30% of small banks are closing their ATMs because nobody goes to an ATM, right. And that's a tremendous shift. And if you take it outside of the U.S., it's even more so. If you think about banking, for example, Mexico, one of the largest banks there, over 90% of the transactions are done in line. If anyone goes for a vacation, don't hope it's not payday because it's 10 or 15 deep at every ATM machine in the country. In the US, hardly anyone uses it, but they're still depositing checks throughout the country. And that will change very rapidly as you have smartphone penetration and the costs have come down. You see it in India, you definitely see it throughout Asia, China, Mexico is a little behind, but it's really transformational. And the cost of squeezing that out is tremendous. And it also gets rid of fraud and a variety of other things because you can literally track everything. And they are.
If I gave you a 10K and you could only read 3 paragraphs and pick 3 numbers, what would those be?
Okay, wait, what's the business model?
You can pick it.
Okay, now, that's
No,
important.
you have to decide that through the numbers. I mean, that's the question.
No, I get the business model or I get the numbers, because different businesses have different pressure points.
But I want you to look at those things and tell me what the business model is. Okay, consumer staples, not to argue
Okay.
with you.
Okay.
On consumer staples?
Yeah.
You know what? This is where I agree with Tony. You got to look at the margins.
Yeah.
And that's everything right now. The
Yeah,
margin
cash flow.
compression, on consumer staples is what's really crushing them.
And cash flow.
Yeah.
Cash flow is always, cash flow for everything is important. So cash flow, margins,
You're not going to see a lot of debt in the consumer staples, but the margin and the cash balances and how they deploy that cash is going to be key. Because you're going to see higher debt, particularly if you look at something like the tobacco companies historically, just generate a ton of cash.
and and probably the first paragraph of the MD&A, Management Discussion and Analysis, because I got to read one thing in your comment, right? The first paragraph, because that's going to tell you the strategy of how if they're losing share, they will fess it up right there in the first couple of comments, like sales were down. So I can, that saves me having to get another number off the income statement. So I can read the MD&A and they'll tell me, and they'll also give me an insight into how they're planning on confronting that and dealing with it going forward.
And if it's Philip Morris, it's elderly Japanese utilizing IQOS. That's what you want to read about. That's what drove their stock this quarter. That's the heat not burn cigarette. Don't smoke.
Right.
Hello, how are you? Thank you for coming here. My name is Tom Wynn from Washington, D.C. It's my first meeting for the Berkshire meeting. And my question, I have 2 questions. First is, what is your simplistic checklist of 5 things that you look at in a business before you decide to buy it? And the reason why I'm asking this question is because recently was listening to a podcast about John Gladwell, and it spoke of blank of how you make decisions. And sometimes the best decisions are simplistic decisions where you have something where you understand and you can make a decision within that minute. Sort of like what Warren Buffett says, he can think about a business and then invest in it within that minute if he likes it or not. My second question is about value investment. Since everything is expensive in the States, I've been looking into emerging markets, China, Thailand. So I like things like YY, Momo. They're like the social media companies of China, you know, the early Twitter, the early YouTube channels. And their valuation is pretty low right now. It's about 10x, 12x, but way below US markets, around 20x plus. So if we're looking at value investment in general and we're speaking about globalization, isn't it time that most value investors get globalized and look at emerging markets and start to invest in it? Because if we look at statistics, statistically speaking, value investment will always bring you value, just like when Warren Buffett just bought a whole bunch of Korean stocks and he didn't know much about it. He just knew that it was going to make him money.
Well, when you look at valuation, one of the key things in some of these countries is, can you trust the accounting? So you got to spend a lot of time there because there has been some accounting fraud, but there's also been accounting fraud everywhere, from Enron in the US to Parmalat in Italy. So I think that's one thing you always got to spend some time on. You happen to mention 2 technology companies, which are theoretically going to be a lot more expensive. If you look at Samsung, which is around an 8 multiple, they just did a think a 50-for-1 split today to make it more attractive to the retail investor, and it was like 20% change in retail volume in one day. Now that the price is lower, it's kind of like buying the $100,000 or $200,000 share versus the $3,000 share, whatever Berkshire B is today. Just more accessible, because people think a $100,000 share is more expensive, but in reality, it's buying one and the same. But I think the interesting thing in the last couple of years is a lot of people were, prior to last year, emerging markets had underperformed for 5 consecutive years. So people gave up on the asset class, even though you could make the argument that there was a lot of attractive value there, and there was some political risk there, some currency risk, and that can go both ways for you. And understanding those risks is also important. The other key thing is you think about the evolution, and we talked about how markets have changed. The markets have changed dramatically, and China is the biggest example. When we started investing in emerging markets in '98, China was less than 0.5% of the index, even though it was basically the 3rd largest economy. Today, it's over 30% of the EM index, and soon to grow rapidly once you add the A shares in. So understanding the structure, the access, all comes into play. When you throw in the A shares, sometimes they're more, the A share and the H shares, not to get technical, but can trade at a premium, but it's hard to get access to that unless you're a big player. So that comes into play, but this has existed in Korea 20 years ago, and India before that. So how do you access it? You can do it through a mutual fund, which is the simplest, or an ETF. But understanding that, how it changes over time, is key, because there's some fascinating changes going on in these countries. But all those markets aren't quite as accessible as say, the US or Europe.
Well, wait, hang on, because you had the 5 things, which we didn't answer that. So, all right, so my quick and dirty on Porter's 5 forces. So you mentioned 5, this lines up perfectly for you. So Porter's 5 forces, one of the most valuable things and tools I learned in business school, and it helps you understand the business model and where the pressure points are. So if I have to do a quick and dirty look at a company and decide whether I want to, do I like it? Does this make sense? Google it online. Porter's 5 forces, it helps put everything in perspective for me, so I know where the pressure points are. And then depending on the business model, because there are only so many business models out there, so once you get this Porter's 5 forces, you've got it worked out. I can go back to this gentleman over here and tell you which 3 numbers I need to tell you everything I need to know out of the 10K.
Just add to that, in terms of the 5, I don't know if that's the right number or not, but 6, maybe Vitaly has 6. The way, and you mentioned Warren doing it in a blink. It's Malcolm Gladwell, isn't it? Not John. But I don't think he does it in a blink. He first needs to understand the business. That's a very important point, that it's got to be something within his circle of competence. And for him, that's a basic business, not a lot of technology, not a lot of complexity. It's got to deliver high returns on unleveraged invested capital over a very long period of time. And it's got to be run by managers that he would trust and admire. That's 3 out of 5. That's not bad. I think when he can decide on an investment in a blink, it's usually because it's outside of his circle of competence, it doesn't have high returns on invested capital, or it's got some peculiar managers with an odd background or checkered history or something like that. And he'll just run away from any of those things. And he adopts the Ted Williams approach to investing. Ted was a famous baseball player who wrote a book about his strategy called The Science of Hitting. I think he's certainly one of the best hitters in the history of baseball with a very high hitting average. So he managed to get a hit every 3rd time he was at bat. It was a very high average over his career. And he explained that the main reason he was able to do that is because he waited. He waited for his pitch. And he only swung the bat when an opportunity was in what he called his happy zone. And he said, if I was trying to swing for a ball that's a little outside or a little inside and always trying to get a hit, I'd hit one out, I'd get on 1 out of 4 times. And And Warren's embraced that same thing. So his checklist is very simple. And if you have that very simple checklist, you can weed out a lot of companies very easily. So that's a sense in which I think he can blink and decide on something in a minute or in 5 minutes, and I've seen him do it. I've seen proposals where it fits a circle of competence, very high returns on invested capital, but there's something a little bit funny about the managerial background, and you can decide on that in 5 minutes. I think to your second question, I agree with Doug that international accounting, especially in emerging markets, has not developed the sophistication, reliability, attestability, auditing function, and so on. So I think you have a lot more uncertainty about that. I think it's changing. I think it's getting better, and I think there's a lot of capital all over emerging markets. So I think that is a trend and a direction. But I think IFRS, International Financial Reporting Standards, needs some work, and then the attestation process. The auditors in those countries probably need to be given a little more spine, a little more power, and but eventually it'll probably come around.
I think we have time for one more question, and this gentleman up here has the mic.
Bear with my analogy first, but being here in the Midwest, in the mid-19th century, there was a myth, and you folks may not be familiar with it, but it was the rain will follow the plow. And in other words, if you turn the soil, you change the environment, the rain and prosperity would follow. It was a myth. It didn't happen. The old rancher that did not change his means or his making a living, he endured the dust storms, much unlike the farmers that followed the myth. Today, it seems like we have a myth that innovation, change, prosperity will follow. If that myth is, well, maybe it's the truth, but are there any sectors or businesses out there, companies, that are like that old rancher that didn't change and weathered the storms? Are there any companies or sectors like that today out there that would benefit by not changing, but just doing what they do and do it well?
So I wrote this long article. So we own one of the cheapest stocks out there today are basically distributors of pharmaceuticals, like McKesson, Cardinal Health, ABC, AmerisourceBergen.
Charlie, can you pull in a little?
Sorry. All right. So some of the cheapest stocks out there are these distributors of pharmaceuticals, and today everybody is paranoid about Amazon. So if you think about it, in the past, like Amazon was able to achieve this incredible leapfrogs because it would do something nobody would care. And let me give you an example, like AWS, Amazon Web Services. Jeff Bezos said that they had a 4 or 5 year advantage because when they started doing this, people looked at it and says, what does bookseller know about the cloud, right? And everybody dismissed it, and therefore they were so far ahead, and that gave them a 4 or 5 year advantage. Today, everybody's, so at the time it was underestimated. Today, everybody is paranoid about Amazon. And therefore, every company out there is thinking, how could Amazon disrupt my business? And therefore, a lot of times now, I feel like you have overreaction to Amazon. So in the distributors, that was a great example of that because, let me take McKesson. McKesson basically takes drugs from Pfizer and delivers them to 10,000 pharmacies in the United States. Okay, they have sales of $200 billion. There was a speculation that Amazon is going to get into drug distribution business. The stock declined 20%. Okay, so and if you logically go through, like, how would Amazon do this? It's just impossible. It's just impossible, and that in itself creates an opportunity. And the reason it's impossible because, first of all, Amazon has zero competitive advantage, right? Because McKesson does not have pharmacies. They just distribute to pharmacies. So they were Amazon before Amazon was Amazon, right? Because they have warehouses. Number one. Number two, they have a buying power of $200 billion. Amazon have a buying power of 0 because they don't, they don't sell, they don't sell drugs. And the list is long. I wrote a long article about this. You can Google my name and my guest and you'll find it. My point is, that's how opportunities are created. So anytime you see Amazon is going to get into the space, sometimes, a lot of times it's create those myths. And I think, that speaks of Amazon, I think it's going to be a phenomenal company, but it's going to be more difficult for them to be as successful in disrupting industries that they did, in the future, than in the past, because everybody takes them too seriously, in many regards. So,
Innovation does drive prosperity. I don't think there's a big debate about that. And your question could have been asked in 1900. It's like, well, now these autos and all these other things come through, and the plow, people don't manually plow the fields anymore. Caterpillar is a service company now. So there are companies that want to maintain their current model. Think of like a Costco. And Amazon competes directly with them, but they've built a moat. They've built a franchise. So that's what you want to look at. It's like, is this company going to be in existence 5 years from now? Is the reason I use the services or products of this company going to be true in the future? And look, I buy stuff on Amazon, but I'm a Costco, whatever, executive, whatever my wife signed us up for. I know it's a very prestigious and elite card, but it's, yeah, you buy a lot of stuff.
It's very important. The other thing I would say here is we talk about technology and, this disruptive, innovative industries, but I'll just caution you, because your point is very valid. Remember that we had the tech bubble. There's a big difference when we had the tech bubble. So we went into the tech bubble and we were all excited about anything that came out of Silicon Valley, could go public, get this huge valuation. And I think at the time, the market stopped looking at the underlying business model. And a lot of those businesses were never going to be profitable. Fundamentally, just logically, it didn't make sense. How are you making money with that? I don't understand. A lot of the disruptors that we're seeing now that are successful are where it's a better use of capital, a better return on capital. And so you can see how the business model makes money. And I think that's an important distinction, because there are guys who will ride it out. If a business doesn't make sense to you and you can't see how it evolves into something that's viable, that produces cash, remember businesses are meant to be profitable, it probably just doesn't make sense and it's not going to survive. And sometimes, and I think this was a great, tech bubble is a great example of that, we forget that and we get caught up in the excitement of it, and you forget that not everything that, status quo is not necessarily going to be all swept away. It's just going to be nudged forward by the guys who come up with new ideas that do make money.
And I'd just add, the way I interpreted the question was just about, are there existing enterprises that enjoy such strong moats as to withstand any imaginable technological onslaught or other kind of challenges? And a few that occur to me are the ones that just have embedded consumer brands that are so special and spectacular, it's just hard to imagine such an onslaught. So, for example, Hermes, maker of scarves and very fancy, expensive scarves and ties and bags. It's hard. They've got a built-in brand with enormous pricing power, tremendous loyalty, a sense of scarcity and elegance and fashion. It's hard to imagine how anyone's going to challenge that business model. A similar thing could be said about L'Oreal, the fashion and beauty manufacturer, where people pay a fortune to look better and stay younger, looking longer, and L'Oreal just has such brand leadership around that. It's unbelievable. Unilever, to go back to the consumer product space, I mean, they've got a distribution model. They're in 130 countries and have deeply embedded distribution systems in the local economies and cultures. It would be very challenging for a P&G or somebody else like that or some Amazonian kind of operation to challenge that. Or take a look at businesses that have developed a very impregnable system of recurring revenue that's very hard to break into, say, the elevator companies around the world, like Otis and Cooney. There are only a few of them. And I mean, there may be new ways to get to the 50th floor of a skyscraper, but mostly it's going to be elevators of some kind, and you can certainly shift from a from a pulley and belt system.
These guys
to a-
use the stairs if they're wearing their Fitbit. They gotta get steps in.
And that's an innovation. The staircase is a very innovative thing to put into a school.
Scotty, beam me up.
There you go. So that's how I understood your question. And there's some moats. And I guess looking inside, I mean, there's some basic things like candies. I mean, C's candies. There's something special about that confection. There's a secret sauce there. There's a loyalty. There's pricing power. They've juggled a little bit with the distribution. They're opening some stores in new geographies and stuff like that. So I think you're right. Yes, there's a lot of pressure all around from technology and other forces. There always has been. There always will be. But there will be some examples of the model you've described.
And then this is like an extreme pivot from your question on innovation, but I'd ask Susan, how would you envision the investment industry or the investment firms will look differently 10 years from now, 15 years from now, or you hope they look differently 10 or 15 years from now?
Yeah, so we started, this is a little bit of a lead-in because this was my rant before we started this official speak. So thank you for giving me the opportunity to rant further. We have such an opportunity, and this applies to everyone, but particularly to you guys, because you are, coming out with this great education and background. I talked about how technology has changed and information is available to us all. We touched on the importance of managements being incented the right way, and they're incented the right way because shareholders vote on their compensation. And so an informed shareholder has a lot of power and the ability to communicate with other shareholders, right? This has really transformed how shareholders can influence management teams. Managements are much more sensitive to it now, and shareholders can have a voice, and investors can have a voice. And because this technology is everywhere, we can all get the data, it really opens up the playing field here. So before, we saw, you might have noticed, I'm the only woman up here. You might have noticed that, right, most of the time when you see someone on CNBC, it's a white guy in a suit, right? We're not the most diverse industry, and that's changing. And so the fact that we have, the ability to have all this information, I think finance is becoming much more to the forefront. Everybody has an opportunity to learn about it. There's a vehicle for you, online, self-education, classes. It allows the industry to open up, and it is not such hallowed ground. What we talked about today, the quantitative part of it, its formulas, its models, that's all, it's a recipe. You follow that recipe, and then you overlay a qualitative onto it. And each individual can bring that own qualitative aspect. It's something that everybody can develop and learn. And so I think where before finance was so unattainable and seemingly, you watch the talking heads address it on television and what are they saying? This is something now that everyone can get involved in and have an opinion on and debate the merits of a business model or a stock. And it's an ability for, there's no glass ceiling here. This is an ability for young women, I'll promote to my demographic, young women to get into this industry and really take advantage of all that it has to offer. I feel like I learn something new every single day. And so this is an incredible, I've never been bored, frustrated frequently, but never bored. And I love my job. I love what I do. I think it is one of the best industries possible to be in because guaranteed you will never be bored.
Thank you, Susan. We're going to break in just a minute. I want to, first of all, I ask you to join me in thanking all of the panelists. I think they did an outstanding job. Every year we just get better. Also want to thank the students and for all the work. There's an awful lot of work that goes into this. Students have been working on this for the last 6 months. And the list of questions that we went through is only one small part of their effort. So join me in thanking the students, if you will. And finally, I want to thank all of you. You've taken time from your busy Berkshire Hathaway weekend. You're going to have a fabulous time in this cow town of Omaha. No, enjoy, and thank you very, very much for coming. Join us for hospitality outside and give yourselves a round of applause.